Hello and welcome to this discussion on decarbonizing heavy industry. My name is James Mitchell, and I'm a co-director at the RMI Center for Climate-Aligned Finance, where I lead our sectoral decarbonization programs and previously led the development of the Poseidon Principles. Heavy industries like steel, aluminium, cement, and chemical production account for around 20% of global annual GHG emissions, and if you lop in the rest of the hard-to-abate sectors, that number quickly approaches something closer to 40%. In many cases, we don't yet have commercial-scale low-carbon technologies ready to roll out across the globe. However, we do know that decarbonizing these sectors will require coordinated action across industry, finance, and policy. We also know that it must be done in a just and equitable way. Discussions around the decarbonization of these sectors were changed significantly by COP26, which both established target setting as the language of ambition, as well as 1.5C alignment as the bedrock of expectations for governments, industry, and finance alike. What this has done productively is that it has unlocked a new set of conversations, ones based in clear-eyed acknowledgement of the barriers to achieving these ambitious societal goals and a global hunt for solutions and scaling mechanisms. That's why I'm delighted and frankly humbled to be moderating a discussion with three industrial decarbonization experts today. Carole Ferguson is Managing Director of Industry Tracker, and Kahrs is Chief Innovation Officer at Alcoa, and Vivek Pathak is Global Head of Climate Business at the IFC. Vivek, I would love to start with you to get the conversation flowing today. So I'd like to ask, with so much to do in these sectors, how should we approach decarbonizing them in light of the scale of the challenge ahead? Vivek.
Yeah, so thanks so much, James, and big thank you to all of you for having me, and delighted to be on this panel. So, if we step back and see what's really happened over the last 10 years is I think we've been able to sort of take care of the low-hanging fruit, which is the energy sector, and the way renewables have picked up and the way prices have come down. I think that's been a sort of significant shift there. But as always, the billion or billions of dollar question is, how do you decarbonize steel and cement there? So a couple of data points, I think. I mean, heavy industries really contribute a lot more to global emissions, and the iron and steel sector is almost 7% of global GHG emissions. And then when we add plastics, which is another major polluter, 1.4 billion tons of GHGs per year, and then things like glass and construction industries and construction materials, sorry. But a couple of things that we need to understand is, if we keep talking about the need to invest more in infrastructure, infrastructure takes construction materials. So if you cannot think about investing in infrastructure without the GHG impact it's going to have in some of these hard to abate sectors. That's one. Second is in emerging markets, which is where we operate largely. These industries really are big employers as well. So we need to take that into account. And if we're talking about transitioning these, we need to make sure that these millions of jobs that they're responsible for are also taken care of, and there's a real just transition there. So, just by way of example, I think steel contributes almost to 50 million direct and indirect jobs globally. And almost 70 to 75% is from emerging markets. Yeah. Similarly, cement, I think, between China, India, Vietnam, and Indonesia, we're really talking about 70 to 75% of global cement production. So what is clear, I think, is the need to decarbonize these sectors. And what is clear is these are sectors that we really can't do without. Like I said earlier, if you need to invest in infrastructure, we need construction materials. And even now, as we're moving away from what was called the hard infrastructure, and we're getting more into digital, data centers, huge consumers only, but therefore they need to decarbonize the materials with which they're being made there. So we really need to approach this to make sure that it's fair for all stakeholders, including the communities where this is a key source of jobs. And we just need to make sure that it's all taken care of, and like I said earlier, the just transition. Yeah. Now, how do we go about doing this? I think, we are starting out in our journey, in all fairness. We've done a very interesting deal in Ghana, a greenfield steel plant, that will use a cleaner furnace technology. We've looked at a very interesting plant in Kenya for cement with cleaner technologies. But what we've not been able to see really is a quantum leap where you can really decarbonize them in a significant manner. Uh, and a lot of this is really going to entail technological advances. In some cases, we're seeing technologies are available, but they're expensive because they've either not been mainstreamed or they're not being done at scale yet. So, what is this whole transition going to take? It's going to take a lot of blended finance for starters, or what we call de risking capital. So that's going to hopefully bring prices down. And then I'm really hoping we have a repeat of what happened in many ways in the solar panel industry, where a combination of blended finance, technological advances, and scaling up has led to a significant decline in prices. So blended finance is really going to play a key role to make it happen. And just by way of example, I think there was a McKinsey study recently that said that the amount of capital needed on physical assets for the energy and land use systems transition is going to be close to $9 trillion a year. Give or take maybe half a couple of billion, maybe between now and 2050. So that really tells us what it's going to take. And unfortunately, a lot of this is going to be front loaded or needs to be front loaded because the later you do it, the worse it's going to be. And the more challenging to reach 1.5 degrees. So what we really need to do is, get the blended finance in there and get the technologies and the cost curve down so that it's affordable. Because at the end of the day, if prices go up in this space, a lot of this is going towards the public good, and that means eventually the taxpayer's got to pay more. So that's what we've been doing a lot of. How do we raise blended finance for this space and try and get the technologies to scale in emerging markets and get the cost curve down? And what's going to be critical again is we will need governments to play a role. That the policies need to be supportive. It's also about doing away with subsidies in other sectors, including fossil fuels. Carbon credits, I'll argue, are going to play a major role in this going forward. As you generate carbon credits, that means your cost curve is going to be hopefully coming down. And very important, we're going to need taxonomies and standards that are going to be standard across markets so that investors are comfortable, whether they're investing in a company in Egypt or in Thailand or in India, the same standards apply and the same set of rules are going to apply for that. Yeah. So these are some of the key things, I think. So it's going to be technology, blended finance, and to get these things up to scale. That's how I think we're going to make a difference. Thanks.
Thank you, Vivek. Incredibly well answered. And if I can use my position as moderator to ask a follow-up question to you and your fellow panelists, one of the points you've made very well is the scale of capital required for the transition, as well as the importance of blended finance. Who's going to pay? Where do these costs sit, and how do you see them shifting over time? Vivek, can I hand this back to you, and then please I'd invite the other panelists to jump in after that.
Yeah, so I can tell you where I think money is going to come from. Whether it'll come from there, we don't know. So I think we're going to see capital, the philanthropic capital is going to play a big role. We're seeing a lot more capital for de-risking coming in from philanthropies, family offices. So that's really the private sector part. Some of it is going to come from governments, donor funding. A lot of governments are now starting to step up and get their donor funding into the space. And some of the burden is going to have to be borne by the consumer, because I think it's all about pricing at the end of the day. It's all about costs here. So I think it's going to be a combination of these three where we expect the capital to come in. And once this comes in, then I think the private sector capital is hopefully going to rush in much faster than we all expect it to. So, but the private sector capital is not coming today until and unless you have some of this de-risking capital or the blended finance, in my opinion.
Yeah, and maybe I can add to that, James, just to say that, obviously, companies themselves obviously have to play a part in this, but their balance sheets are just not going to be able to support the sort of, scale of financing that's needed for them to sort of invest in low or zero carbon technologies. So you really do need sort of some form of blended finance or even direct government financing. We're seeing in steel, for example, in Europe, and also on the demand side. I mean, for example, steel goes into the auto sector, and we are seeing, where very small scale zero carbon is being deployed in Europe, where offset agreements are being put into place between car companies and steel companies, where they're willing to pay a premium for that low or zero carbon technology, a steel that's going into the autos material requirement. So I think you really do need both sort of supply and demand side solutions to come into play.
Thank you, Carole.
James, if I could just follow up from the Alcoa side, one of the the way we think about it is until you have a global carbon price, it's really the consumers that are driving the change necessary, because they're the ones that are willing to pay the incremental amount for those products. And quite honestly, consumers today, if you look at a product like aluminum, are not paying the full value when you look at what it would take to abate the carbon in the supply chain. So we think of it as kind of before and after carbon pricing. When you get to the point where there is a global carbon pricing, then you have a built-in financial incentive to improve. And I think the acceleration of industry adoption will be there because they'll have a financial reason and a way to justify that capital. But before then, it has to be a partnership. It has to be a multi-level partnership between all stakeholders when you consider governments. We've seen strong partnership and interest in countries like Canada and Norway and Australia that have been willing to step forward and say and put funds to get together straight as capital avoidance for industries like ours, as we are trying to bring some of these solutions to market. So we've also seen interest in consumers like Apple. Apple stepped forward and has been funding a piece of our ELYSIS joint venture, which is intending to help decarbonize the smelting business. So it has to be multi-level at this point. But when you get to the point where there is a global carbon price, I think the rest will naturally start to take care of itself.
Thank you. So a few trends emerging here: the importance of technology, the importance of blended finance, and the importance of policy. Carole, perhaps we can turn back to you. What are some policies that you think will be helpful to achieving the decarbonization of heavy industry? Are there some things on the radar today that you think are going to really help accelerate the pace of change?
Yeah, I mean, Ben just mentioned the carbon price. So, looking at the European steel sector, for example, you've seen, European steel companies being very much part of the EU European trading scheme for a number of years. I mean, that scheme has been around since 2005. But the carbon price that's come out of that scheme really hasn't acted as an incentive at all for European steel companies to transition from their sort of, highly carbon intensive production processes into low carbon technologies. And the reason for that is because you've had, free allowances to protect European steel companies from their international competitors, since steel is a internationally traded commodity. So even though you've had a carbon price, it's been an incredibly weak carbon price with really no pricing signal or incentive, with steel companies like Arcelor having 85% of their Scope 1 emissions covered by free allowances. But I think that's all about to change in Europe. And I think it's a kind of like a really interesting case study, because you've had this, a very weak carbon pricing environment, but we're going into the fourth phase of the EU ETS, where, obviously where the cuts in emissions through that scheme are going to be much, much deeper, so that Europe can, achieve its carbon neutral goals. And at the same time, free allowances are going to be pared back. But what's really interesting is, the potential introduction of the carbon border adjustment mechanism. And this mechanism would, as a carbon tax at the border for any imports coming into Europe with lower carbon credentials, with the carbon tax mirroring the price of carbon traded in the EU ETS. So, we've seen the carbon price within that scheme expect these kind of changes coming into place. And, over the last year, you've seen the price of carbon really ratcheting up. And I think now coming into sort of the level at which it could start acting as an incentive. And as Ben said, I think companies and a lot of people have been waiting for a good carbon pricing signal. But I don't believe that the carbon price is the only thing that will act as a trigger to deploy the kind of level of capital we heard about earlier from Vivek. We really need a combination of a high carbon price, as well as financing instruments to enable the kind of deployment of investment for decarbonisation to take place. And just one other thing to add, I mean, there's a time horizon to this. We can't just wait for everything to align around a carbon price. We need people to start moving in now and providing the sort of financing that companies need to move away from some very old assets, by the way, in Europe. Some of the steel facilities in Europe have been around for decades, and if they don't reinvest now to move away from some of their old facilities, they'll be locking themselves into long-term capital assets, which are much too highly carbon intensive.
Thank you, Carole. Just to follow up on one specific point, and then I'd love to bring Ben and Vivek back in. Perhaps you can expand on that final point you've made. There's an aging steel asset base in Europe. They're approaching the end of their investment cycle or their relining cycle. What's the significance of that for climate as well as for the financial community?
Yeah, I mean, I think there are two things. Firstly, we know that these relining cycles come up every 15 to 20 years. With an average of around 17 and a half years. And so some of these really old steel plants are coming up for that relining cycle. So if companies invest in a reline, which can be anything between $150 to $250 million in capex, they risk locking themselves into an old technology. So for an investor, it could mean that they can't, they could face write-downs in the future. But as these relining cycles come up, if companies take that as an opportunity to try and move away from sort of business as usual, the blast oxygen furnace production route into a new technology, that would over time provide a better return. Otherwise, they risk reaching their carbon budgets, and also the risk of having assets that they'll need to write down. So for lenders, whether it's an investor or a bank, lending to these companies, these decisions are now, I think, becoming more imminent for companies to decide. And just as an example, you've seen, Oslo with, they have three steel plants, one in Spain, one in Belgium, and one in France that has, come up for relining, where they've made a decision to shift to hydrogen direct reduction as an alternative technology. And the timing has been, helped by governments coming in and investing, co-investing with them to make that shift.
Thank you, Carole. Very well put. I think clear demonstration of the urgency for what you've laid out, as I think sort of both the need for carrots as well as sticks to really kind of move these industries in the direction of decarbonization using the appropriate tools of policy blended finance, etc. I'd like to bring Vivek back in, and then perhaps Ben. Vivek, any reactions to what Carole has just laid out? Any specific policies that you see that are promising on the horizon, or things that you hope to see to really accelerate the decarbonization of industry?
So I think we're not seeing too many policies, but I'm hoping we'll get there and just make it harder for people to do what Carole explained. And instead of just sort of refurbishing an existing plant, is to really see how they can decarbonize it. Because not only from, I mean, Carole put it very well from a lender's perspective, but I think what we also need to get the message across both to the corporates as well as the governments, that if you don't decarbonize, the probability of you being shut out of global value chains is going to get higher and higher. And that's really one of the angles that we're taking in a lot of our client countries, which is emerging markets, is that if you don't decarbonize your heavily emitting sectors, in some shape and form, scope 3 emissions are going to start kicking in, and you're going to be shut out of these value chains. So that's one part of it. The second part is on the financial side. If you do decarbonize, then hopefully carbon credits and things like that will make a lot of these a lot more profitable. Thanks.
Yeah, if I can jump in, I work with the IAI, International Aluminum Institute, and they've worked with the International Energy Agency to set targets for each of the industries that are consistent with the 1.5 degree scenario. If you look at the aluminum business in total, to be consistent with that, by 2035, 75% of all the CO2 in the entire value chain has to go away, right? Which is an enormous amount of reduction when you consider, as you said, the capital required to solve some of these things. And the thing that stands out about aluminum is the direct emissions is notable. The indirect emissions, specifically with the power that we consume in the aluminum business, is the big behemoth. And when you think about the difference between a hydro-produced or renewable-produced aluminum unit and one that's attached to a coal-fired power plant has a CO2 intensity of 16 tons per ton of aluminum. So 16 tons of CO2 are produced for every ton of aluminum. And so when you think about CBAM specifically, and Carole, you were talking about the structure of CBAM, one of the things that's been debated is whether scope 1 and scope 2 should be included. Well, in the aluminum business, if you're not including scope 2, then you're ignoring the biggest problem there. So CBAM, in our opinion, needs to be structured to make sure we're providing the right incentives for both the direct emissions in scope 1, but also the indirect in scope 2, because for our business, that's where the lion's share is. Secondly, there's some enhancements that can be done with CBAM, and we are completely behind global carbon pricing. We think CBAM is hopefully a starting point to that. But there are some elements of CBAM that are in some ways encouraging the wrong behavior. If you look at Norway as an example, Norway is tied into the European grid via interconnection. So if you're selling a megawatt in Norway, it's actually based on the price in mainland Europe, which has a carbon component, right? So if you're a producer in Norway and you're buying power, you're actually buying power that has a carbon component in the price, even though you're buying power that's coming from a hydropower plant. And so when you think of, there's mechanisms like indirect compensation that are meant to address that, and CBAM currently has those going away. So we think CBAM is fundamentally going in the right direction and fully support carbon pricing, and hope that this will be a template that others can adopt. But obviously, there are some enhancements like the indirect emissions, like indirect compensation, we think need to be adjusted to make it as effective as possible for industries like aluminum.
Thank you, Ben. Let's turn to, I think, the third major topic here today, which is technology, which I'm almost certain will bring us back around to everything else that's required to achieve that technology. Ben, we've talked about policy. You've mentioned the IAI roadmap as well as Alcoa's work. Tell us about the technology we need to hit 1.5C. Of course, the situation varies by sector. Since we have you from Alcoa, can you really drill down into what it's going to take to get us to 1.5C in the aluminum sector?
Absolutely. So I'll start with a non-Alcoa answer, and then I'll get to the Alcoa answer. From a non-Alcoa answer, the very first thing, and I mentioned it before, is to decarbonize the grid. If you look at how the aluminum industry has grown over the last 20 years, the most significant growth has been in China, but the template has been to put a brand new smelter in place and put a brand new coal-fired power plant right next to it, right? And so in order for us to get where we need to go for 1.5C, as significant as those indirect emissions are, the first thing is that we need to decarbonize the power grid, and we need to get access to stable, consistent, renewable megawatts. So that's number one and very significant. But when you think about Alcoa in total, we've set a course to redefine the aluminum industry for a sustainable future, and we're doing that through technology. And we see three major pieces to that. The first piece is anode-anode smelting, and you've heard us talk about our ELYSIS joint venture with Rio Tinto. The intent here is to take all of the CO2 that's generated by the smelting process itself, which is about 2 tons per ton, and to actually replace that emission with oxygen and completely eliminate all carbon from the value chain. So I will tell you from the Alcoa side, this is a project we've been working on since 1980. So it's a very long-standing technology project. But we've announced recently with the ELYSIS joint venture that we intend to have the first technology package for sale by 2024, with the first hot metal to come by 2026. So this is on the horizon, and what's important for us is to take this from an ambition to a decision point. If you can get it to be a decision point, and now you can apply some of the capital approaches that Vivek was talking about, it gives producers a much more tangible solution rather than an aspiration, a tangible solution to decarbonize. The second occurs actually earlier in the value chain for aluminum in the refining sector. The refining sector is a pretty standard consumer of fossil fuels. If you look, most of the fossil fuels in the business are actually coal fire again, and therefore you have that same coal fire intensity as you do in the smelting side. Alcoa largely is natural gas, and so we have the lowest carbon portfolio of refineries in the world. And there's two technologies that we brought forward for that one: mechanical vapor recompression and electric calcination, that completely eliminate all CO2 with the refining process as well. And while doing so, also eliminate 70% of the water usage in refining, which is also important to areas like Western Australia, where water supply is becoming more scarce. Lastly, and to complete our low carbon position, Alcoa has brought forward another project called Estrella. And Estrella is a technology designed to be able to take in-consumer scrap. So think of auto shred scrap, which can be a mix of several different alloys and solutions, and to be able to take that and beneficiate it back to what's called a P0101 standard, which is a purity of aluminum that's higher than what comes from any smelter in the world. So when you think about in combination, the decarbonization of the electrical grid, unique solutions for aluminum that eliminate all of the CO2 involved in the value chain, and then a real focus on end consumer recycling, we think that will be the most significant technology roadmap for the aluminum industry. We're very happy to lead that, and happy to pass back to you to talk about how that connects to the capital and policy.
Thank you. So one follow-up question, Ben. I think you've clearly demonstrated the importance of technology in achieving a 1.5C aligned aluminum production sector. Within that, you clearly outlined the role of technology. I'd like to pick up on one other thing that you mentioned, which is the importance of renewables procurement, or the importance of grid carbon. Of course, this is particularly the case given the scale of emissions from power generation used to produce aluminum. Can you tell us what challenges or opportunities does this pose to business strategy as an aluminum producer? How do you source energy that is lower carbon to bring your emissions down as a company?
Well, I think it's in some ways regional, right? And some of it's waiting on some technology. Excuse me. So when you think of regions like Canada, Norway, those types of areas, typically hydro is available, right? But beyond that, when you're trying to go beyond just the available hydro, because typically an area will get hydrosaturated with as much as they can generate, the next one that we've been going to is wind. If you look in Norway has had an explosion of the wind in the last decade or so. We've actually signed 3 PPAs on wind power that are backed up by hydro to power one of our smelters in Norway. So that's the next logical one. One that we're looking at in Australia right now is offshore wind. So we have 2 smelters in the world that are based largely on carbon, and Portland, Australia is one of those, and we're working on an offshore wind project to consider what that could be for us in the future. And so I think you have to work with the available solutions that are available in the market. We as Alcoa intend to innovate in the technology space for aluminum, but we're not going to be able to solve all problems. We can't eliminate bunker fuel in ships. We're not going to decarbonize the grids, but we can be partner for those that are. And so that's what we're trying to look for is opportunities and partnerships with folks that are innovating in these spaces to be more of an early phase adopter and work with governments in the regions to try to make some of these projects a reality.
Thank you, Ben. I'd love to open this back up to Carole, to Vivek. So we've just heard the importance of technology, also the challenge, I think, in terms of what it will require to achieve decarbonization in the aluminum sector. I'd love to broaden it back out. How do we marry this up with policy, with finance? Any reactions to the challenges that I think this sector or other sectors face, and how we marry that up with what's needed in finance and policy?
Yeah, thanks, James. And just picking up on what Ben was saying about renewables, I think the availability of renewables and the continued sort of deployment of renewables is going to be key to other technologies that need to be deployed for decarbonisation to take place. So, for example, hydrogen direct reduction, which is an alternative technology for steel production, will depend very much on the availability of renewables so that you can have a green hydrogen supply for that technology to be deployed.
Thank you, Carole. Vivek, is there anything you'd like to add in response to Ben's comments about the importance of technology in achieving 1.5C in the aluminum sector?
I just want to reiterate the importance of technology. And like I said earlier, that how do we bring these costs down? So I think technology is going to be really critical to make this whole thing happen.
Thank you, Vivek. Well, today's conversation has been absolutely fascinating. We've heard about the importance of technology in achieving 1.5C across industry, the importance of policy in helping us get there, and the importance of blended finance in helping accelerate efforts and ultimately helping us achieve our aims. Something that I would be remiss if we didn't cover also is just transition. So I'd like to offer you each a chance to discuss, what does a good transition look like? How do we ensure that as we achieve our transition through a use of technology supported by policy, implemented with blended finance, how do we also think about a just transition on the way? Carole, I'd like to start with you, Ben, and then Vivek.
Yeah, thanks, James. I mean, I think, Vivek made a very good point about just transition at the start of the session. I mean, obviously, we know that a lot of these hard to abate sectors in steel, cement are huge employers and are an integral part of communities where they are based. So I think, thinking about how you get people on board when you have to introduce disruptive technology, I think is going to be key to ensuring that we can get a smooth transition, and we can't ignore the sort of social dimension when we think about transitioning.
To pick up from that, this CO2 problem is a global problem, and to attack global problems regionally and separately is typically a mistake. And in our opinion, the path to get to 1.5 degrees has to be something we collectively go after together as countries and regions. The incentives, whether they be the carrots or the sticks, need to be equal across those regions, so that you don't promote one region that's less aggressive and then benefits economically. In order for it to be just and fair, you need to have that consistency by region. And then as we pointed out, it needs to be a transition. It can't be a cliff that you drop off. It needs to be a transition where consumers are slowly exposed to the cost of making the products the right way with the right CO2 intensity, where industry has the opportunity and also the foresight to see when carbon pricing is coming and the significance of that, so they can make the necessary capital adjustments and start to put some of these solutions in place. And then the technology has to be there. Folks like our innovation team have to be able to deliver some of these R&D projects that are critical to the transition. So it has to be a collection of those, but definitely taking a global approach is critical.
Vivek, over to you for closing remarks on the just transition.
Yeah, so I think the just part has been covered well, and I'll pick up from where Ben left off in the importance of a transition. This is not an on-off switch. This is going to take time. It's going to take a lot more effort than some of the other sectors that we've seen. And like I keep reminding my stakeholders, the probability of us making mistakes and the probability of things going wrong when we're going to get into something as challenging on this is going to be relatively higher. And we need to be prepared for that. We need to make sure that all stakeholders, including the CSOs, are prepared for this. And, that's something that's critical because otherwise, no one's going to embark on this. Yeah. So the importance of the transition and taxonomies is going to be very important. We need to make sure that the taxonomies are clear so that the investors and the lenders are clear on where their money is going and they can be measured. So I think it's going to be important that we focus on the just piece, which I think Carole touched upon, and the transition piece, which Ben touched upon, are just equally important. Thanks.
Carole Ferguson, Ben Kahrs, Vivek Pathak, thank you for a fascinating discussion. It's been a pleasure.